Hello, I'm Brian Nick, a strategist in our Chief Investment Office at UBS Wealth Management Americas. Today I would like to talk to you about a concept I work with every day, risk-adjusted return. If you've watched my colleagues in prior videos, you're familiar with a few different definitions of risk. To recap quickly, the most common measure of risk in investing is standard deviation. Standard deviation defines a range of returns within which investors can expect about 2/3 of observed returns to fall. We say asset classes are riskier when they have higher standard deviations, and we expect those asset classes to deliver higher returns on average than others that may have little to no market risk. That brings us to the concept of risk-adjusted return, which allows us to compare apples to oranges in a sense. By adjusting either historical or expected return on an asset class for a degree of risk, we can compare, for instance, U.S. Treasuries to U.S. equities when deciding how to invest. If we were to invest solely based on maximizing return, we would probably prefer U.S. equities almost all the time. But if our goal was to minimize risk, U.S. Treasuries seem the more prudent choice. Risk-adjusted return allows us to combine these concepts, and there are many ways to measure it. Today I'll summarize just one example, the Sharpe ratio. The Sharpe ratio measures units of expected excess return per unit of volatility. Excess return is simply the return we've received or expect to receive over and above the risk-free rate. These days, in most parts of the world, this calculation is quite easy because risk-free rates are close to zero. A high Sharpe ratio indicates a high risk-adjusted return, while a low Sharpe ratio indicates a low risk-adjusted return. I'll demonstrate how the calculation works by using the two asset classes I mentioned earlier. Let's say that U.S. Treasuries have given us a return of 3% with a volatility of 5%, while the risk-free rate was 1%. That would make the Sharpe ratio 0.4, 2% divided by 5%. Now let's say that U.S. equities returned 14% with a volatility of 10%, similar to their return in 2014. That would give us a Sharpe ratio of 1.3, 13% divided by 10%. 1.3 beats 0.4. In this example, equities have delivered a far superior risk-adjusted return. If only that were always the case, our job would be easy. So why does risk-adjusted return matter? Why wouldn't an investor prefer a return-maximizing portfolio with 100% in risky assets? After all, over time, that strategy has performed very well. The problem with this, as most of us know, is that very volatile investment strategies are often difficult for investors to stick with when times get tough. So including other asset classes with positive Sharpe ratios but lower expected returns is optimal for nearly all investors. By doing this, we sacrifice higher returns for higher risk-adjusted returns and, in all likelihood, increase the probability we stick to our investment plans and meet our financial goals. Risk-adjusted return is particularly important for investors whose portfolio returns make up a large portion of their total income, such as those in or near retirement. These investors are subject to what we call sequence risk. Because they must withdraw from their portfolios over time, they care very much about the sequence of the returns they receive on their investments. Significant losses in the first few years of retirement can make it difficult for investors to meet their financial goals. For example, those who retired in 2007 and began withdrawing from their portfolios could have found their invested assets cut in half after just 1 year, but their cash flow needs unchanged. Depending on how much they withdraw each year, this could have been a significant obstacle to sustaining their standard of living throughout retirement. Designing a portfolio with risk-adjusted return in mind may sacrifice some upside in order to avoid the kind of volatility or drawdowns that can knock investors off course. I hope you found this video helpful. Investors who internalize the concept of risk-adjusted return are well on their way to understanding how to build an asset allocation, benefit from diversification within and across asset classes, and give themselves a smoother investing ride than they would otherwise have had. Thank you again for watching.